Hi, this is Matthew Cratter from Trader University, where I teach traders just like you how to make money in the stock market. Now, we're in a little bit of a celebratory mood here at Trader University. Turns out our Tesla earnings call was right on in terms of what to expect. If you're interested in Tesla and following this company, and especially my trades in it, be sure to hit that subscribe button. And if you're still following certain channels, maybe financial education, Jeremy over here, and if you're investing your life savings in Tesla, please be careful. This guy doesn't know what he's doing. You can see based on his most recent earnings call. So let's get right into the Tesla earnings. It was much worse earnings than expected, and company lost a little more than $400 million in the second quarter. And there was just a lot of bad news associated with it. It was as bad as a Model X crash, in fact. Stock gapped down quite a bit yesterday. You can see it gap down on higher than normal volume, which is a very bearish sign. And we still have the 50-day moving average below the 200-day moving average. And it looks like we're going to be testing that 50-day moving average. If this gives out, we're definitely in for another leg lower. Now, as we talked about before earnings, we were testing a very key level here, the 260 level, which had been support for a while for the last couple of years, 2017, 2018. And what happens is when very important multi-year support like this is broken, it can function as resistance on the way up. So we had a very big sell-off, and then we had a bounce, a bit of short covering over the last few weeks. And now you can see that with earnings coming up, that 260 level has been definitively rejected. I don't think we'll ever see it again, and we're resuming our downward movement here. Now, this is really extraordinary in such a strong bull market. You have Google, you have Microsoft, you have all these stocks hitting new highs. Tesla's down, call it 35% for the year, when the S&P is up over 20%. So it's underperforming by 50%. You can only imagine what's going to happen to this company if we enter a recession or a bear market. It's going to be a complete disaster. And not only is the stock selling off, the bonds are again back in junk territory. These are the Tesla bonds maturing in 2025, trading at a junk yield. These are bonds that will probably never be paid off. Or if they're paid off, they'll be paid off by selling Tesla assets to pay for them. Meantime, there was more to the earnings that was very bad. The longtime co-founder and the second most important person at Tesla, next to Elon Musk, J.B. Straubel, is stepping down. Now, he's not stepping down because he's super bullish on the company's future. I think he wants to get out. So you can add him to the list of over 100 really high up executive departures. This is a sinking ship, and the rats are just jumping as fast as they can. This is quite a blow for Tesla because this guy was a really smart guy who contributed a lot to the company. Meanwhile, all of the executives there are dumping their stock. You can see this is just a partial list of sellers in 2019. Looks like I can't mark on here. The only guy who's a buyer here is Elon Musk buying $25 million worth of stock, which would be equivalent if I bought about $25 worth of Tesla stock. Everyone else is a massive seller: 5 million, 4 million, 5 million, 10 million. People dumping the stock, including the Jeffrey Straubel, who we just talked about, the CTO, who is quitting. Meanwhile, we learned a little bit more in the Tesla earnings report that the acquisition of SolarCity has turned out to be a complete disaster. We already sort of knew this. It's added to the debt load a huge amount. But what we learned now is that they've installed even less, just 29 megawatts of solar generating capacity in the second quarter, the fewest megawatts ever. This is basically a dying business that has only contributed to Tesla's debt load. And this is going to be one of the key things that ends up bringing down this company. Meanwhile, this article leads saying Elon Musk once called this acquisition of SolarCity blindingly obvious. Of course, he was bailing himself out, and he was bailing out his cousin or nephew, one of the great examples of corporate malfeasance of the century, really. Now, another really interesting thing we learned from the earnings report is that this is no longer a growth company. Tesla is no longer a growth company. Now, one way you can see this is if you look at the quarterly depreciation numbers. So here we have the most recent quarter that was completed June 2019, depreciation of $578 million. What you're basically doing here is you're accounting for the diminishing life of fixed assets, and you're sort of allocating the cost over a 10, 20, 30-year period. But what's extraordinary is if we look at Tesla's capital expenditures, their capital expenditures for the quarter were only $250 million. Now, if you have depreciation of almost $600 million and you're doing CapEx of $250 million, you are not even spending enough money to maintain your existing assets. You're basically in liquidation mode, where you're not fixing factories, you're not updating them. And what's extraordinary about this CapEx number, it also includes the build out on the Shanghai Gigafactory. So this is a company that's not even real growth companies. Their CapEx will always be above their depreciation numbers. So this is another place where being able to read financial statements can really help you out. Now, the other thing we learned is that Tesla says they have cash of $5 billion. This is probably overstated. They've been playing some games with their cash. But let's take them at their word. They were able to raise a little more than $2 billion in their when they issued equity and debt to further lever up their company, dilute their company in May. But let's take them at their face value. Now, so if they have $5 billion in cash, which I seriously doubt they do, they have another debt payment. They're going to have to pay back some debt, about $500 million, $566 million in this November. Meanwhile, they're burning about $2 billion a year. Either they're burning through cash or they're scaling everything back. And what's extraordinary is a growth company to have such low CapEx and to be sort of scaling back everything. This implies to me that they don't actually have this much cash. Let's give them the benefit of the doubt, though. Let's say they have this much cash. So they have $5 billion. They're going to have to spend $500 million in November paying back some debt. And then in March of 2021, they have a really big debt payment due, $1.4 billion. Now, meanwhile, this is a company that's burning, they burnt $400 million in net income. That's not a free cash flow number. This company is burning anywhere from $1 to $2 billion a year. So I believe this is a company that's going to, they're going to run out of cash not as early as I thought they were. But this is a company that's essentially in liquidation mode, especially when you're not replacing your assets at the level that they're depreciating at. So I want to talk a little bit about what I'm doing with my position. I've been long these the Jan 2020 50 puts. And ironically, this has been a bad trade. I put these on and I first started talking about Tesla as a short when Tesla was at 300. Tesla's now at, call it 230. Tesla's gone down quite a bit. I paid $230 for these puts, and I bought one round at $230. I bought one round at $1.62. Very risky trade. I've lost money on it. They're now traded just 47 cents. You can see after earnings, what will often happen is that the implied volatility, the uncertainty will come out of the puts. These expire in January of 2020. I think I was overly optimistic in how quickly Tesla would fall apart. But we're definitely on that trajectory. This has the same chart as one of my subscribers has pointed out as Enron and Lehman. So what I'm going to do is I'm going to buy myself a little bit more time. I'm going to sell these puts today and take my loss, and I'm going to roll the proceeds into a new position, a new put spread, which I'm going to show you about in the next page. So what I'm going to do is I'm going to be buying. I've talked a little bit about this in a previous lecture, a previous video. I'm going to be buying the 200 strike puts that expire in June 2021. Now these are currently trading at $48.25. And to fund that purchase, I'm going to sell the 75 strike puts that expire in January of 2021. Now, you basically, to buy the 200 puts, you pay $48.25 roughly. And then by selling the 75 puts, I will recoup $6.90 of that. So for one contract, each contract will cost, this is a little bit expensive, not everyone might be able to do it in their account. Each contract will cost, the total cost will be $41.35, and we multiply this by 100 because there are 100 shares per contract. So this is roughly $4,135 for one contract. Now, how should we think about the payoff for a trade like this? Well, basically, when you are long a put that is above a put that you're short, the max payout is just the difference between these strike prices. So then max payout on this will be 125. And we're risking the premium that we pay, which is 41.35. So think of this trade as basically like a stock where you can buy it at 41.35 and sell it at 125. So that would be one case scenario. Now, if the stock rallies, if the stock is above 200 before these two puts expire, we will lose this entire amount. So if you buy one contract, you'll lose $4,135. Now, the best case scenario would actually be something a little bit different. You'll notice how I picked the timing for these puts. So the put that I'm long expires in June of 2021, and the put that I'm short expires in January of 2021. So what this is betting on, this is betting that there's going to be some chaos in March of 2021 when Tesla has to pay this $1.4 billion. Now, they may not be able to raise money between now and then. They may not be able to pay this. And so if this happens, what will happen is that there's a good chance that, well, let me put it this way. If the stock goes down before then, we'll pocket 125 with a cost basis of 41.35. But let's say that Tesla so this put expires in January 15th, 2021. Let's say February 1st of 2021. Tesla is still trading above 75. Maybe it's fallen quite a bit. In that case, this put will expire worthless. So we will have collected 690. This will expire worthless, and this will disappear. We get to keep the 690. In that case, what happens? And basically, I use the example of February here. It's really any time after January 15th, 2021. If that expires worthless, what are we left with? We're left with being long a put at 200 with a strike price of 200. So if Tesla goes to zero after January 15th, 2021, these puts will be worth $200 a piece. And we will have paid $41.35. Now these have a little bit less leverage. Well, let's first think about the return here. So for $41.35 to 200, that's about 4.5, 5x times on your money. So 400% return if I'm doing that correctly. Now this has a little bit less leverage than these. I was hoping that we would see a much sooner collapse in terms of the January 2020 50 puts, where we basically, we were paying call it 230 for them, and they were going to go to 50. That is still the high leverage way to play it. But the problem, as we saw, is there was a lot of time decay. There was some implied volatility move down, and so those puts, even though we were right, they lost money. The nice thing about this is that as if there is time decay, and there will be time decay, it will affect both of these. And so while we're losing money on being long this put, if there's a collapse in implied volatility or time decay, this put will also be decaying as well. And we do get this credit up front, so that will sort of offset things. So just to summarize, I'm selling my Jan 2020 50 put, rolling into these, adding a little bit more money into the trade. This buys us a little bit more time to watch this fraud implode. If you have any questions, please drop them in the comments below. Hopefully this made sense. I'm on vacation here in Southern California, and I think I have beach mind. I'm not thinking totally clearly in terms of explaining these complicated concepts. But hopefully you found this video helpful. I can do a clarification video if anyone needs it. If you enjoyed this, please click the like button and hit that subscribe button if you want to get more of these from my channel. Thanks a lot for listening, and I'll see you in the next video.